Hello everyone, welcome back to another video. Today we're going to continue the how to analyze a CIM effectively video series. This is the third and last part. And so if you haven't watched the other parts, this is really the purpose of this video series is to talk about how do we actually review a CIM when looking to buy a business. And so my background, I'm a Canadian investment banker focused on the lower middle market. So I play in that $2 to $50 million enterprise value range. And there are oftentimes situations where I help buyers really analyze business opportunities and provide that sounding board. And so what I'm trying to do here is provide very common questions and situations and provide some examples for you to think about when looking at a business to buy. But there may be situations that need more dialogue. And so if you're interested, you can actually even book a 1-hour call with me. Just go in the video description and you can click on the link and book a 1-hour session, and I can be that sounding board to help you buy your first business, or maybe it's your next one. So let's jump into it. So very briefly, a confidential information memorandum is really the common selling document that an M&A advisor or business broker would use to summarize a story and tell the opportunity and sell that opportunity to business buyers. And so the format of the CIM is pretty common across the board, across North America. And in the first part video series, we zeroed in on the financials, the questions to ask, how to run certain calculations on the financials to confirm the quality of the financials. The second part, we talked about the customers, suppliers, and really the business model and the products or services and how to value that business from that point of view. And in this video, we're going to be talking about everything else, really the employees, the real estate, the legal and IT, and the ownership structure, and certain questions to ask. And funny enough, I actually think this is one of the more important videos when it comes to qualifying opportunities to see if the business has been set up right correctly and how to assess the invisible risks behind a business acquisition. So let's jump into it. So before we begin, I thought about putting this up right at the beginning in the first part, but I thought, you know what, I'm going to leave it for here, because if you made it to the third part, I think this is a really kind of cool slide just to talk about. So whenever I get one of these 1-hour kind of consulting sessions, the very first place I actually start, even before I start reading the CIM, is I actually do a bit of background research outside of the CIM. And just remember, broker is going to put together this document and send it to their client, and the client's going to have to sign off on the wording. So obviously, any juicy details are not going to be in that document. It's really more of a selling document. So if you really wanted to find out about the culture, any incidents, any news situations that were newsworthy, well, you're not going to find that in the CIM. You're going to have to do your own research. So where do I go? Where do I kind of snoop around to get that intel? Well, the first place I start is actually the Google reviews. I'll Google the business and I'll go to the Google reviews and actually filter by the lowest review and try to understand low reviews. Oftentimes it's just customers looking to grind an axe, but maybe there's some common themes there, that there's one bad employee or rude employee or whatever the case is that needs to be dealt with. And that's just knowledge that I'm trying to accumulate on the business. The other one is Indeed and Glassdoor. So this is really the job boards where a business may be posting jobs for hiring situations, and employees may also post reviews about the employer. And actually, funny enough, this is a really good place to get a sense of company culture, especially if it's a bigger organization where there's several reviews. I've come across manufacturing entities where, I've really kind of found out, what a tyrant the owner is, even before meeting the owner, because I read the reviews and, people are saying this guy's crazy. So you may find that out just by looking at that. The other one is the website. Like, I can't imagine, it amazes me sometimes that the number of buyers that actually just don't sift through the website. Like, oftentimes, I go to the about page or I go to the news tab and I just try to understand. They'll post an interview or they'll post an article in which they're referenced, and I'll read that article and I'll just try to get a story. So recently I was looking at one business where, I opened up the news page. There was an article about the business probably from 10 years ago. I read that article and it was talking about, other owners involved in the entity, and that wasn't mentioned in the CIM. So we asked about that and we found out that there were other key owners that recently left, but we would have never found that out if we didn't read that article. So, these are some of the things that you want to pick up on. The other is Google News. So, are there any articles referencing the business? Maybe there's interviews. So if it has the owner been interviewed at a trade association or at a local chamber of commerce, watch the interview, watch how they talk about their business and really their ambitions and the risks that they face. And then the last one obviously is the LinkedIn profile of the owner. So make sure you do not connect with them, like don't friend them or anything like that, because that makes it feel uncomfortable that, hold on a second, you've signed an NDA and you're publicly connecting with me on LinkedIn. But look at the profile, look at, see what previous experiences they've had. See what age they're at. That's a big one, because sometimes the CIM doesn't really share the age. And, they may have on their LinkedIn that they graduated 10 years ago and they've owned this business for 5 years. So they're probably not going to be that old. So these are some of the things that I want to pick up on. But at the end of the day, really you're trying to gather as much miscellaneous information to really confirm the story that's going to be told in the CIM. And then there are certain situations, I don't recommend this most instances, but say for example, you're buying a B2C business. So a couple of years ago, we sold a kitchen countertop business, for example, and there were a couple buyers that actually drove out and mystery shopped the business. They walked in as just unassuming, customers, and, oh, I'm looking to buy a kitchen countertop. Can you help me? And they went through the process just to confirm the culture and quality of the sales experience. And funny enough, thankfully it came back positive, but that may be a way for you to just test things out, but be very careful not to get caught doing that. That is, mistake number one. If you go and you disclose to the employees, you've pretty much just shot yourself in the foot. There's no way you're going to get that business. Okay. So let's look now at the employee side. So in most CIMs, they may give you a breakdown of the employee graph, to say, okay, here's the owner, here's kind of the middle management team, here's the middle management team, and then here are the people on the shop floor delivering the service or the product, whatever the case is. So really, when you look at this employee organizational chart, the key question for me when I look at is how many layers of management exist. So in this situation, it's the owner, but then there are managers below the owner that manage the divisions, who then VPs report into the middle management, and then there are also the junior level employees and the people that are doing the work. So there are multiple layers of organization here. Now, say for example, these middle level managers didn't exist and everyone reported directly into the owner. Well, that would indicate to me that the key owner risk is higher, because everyone is directly reporting into the owner. So visually thinking about this story, just try to understand, what does the owner's day-to-day life look like? Who do they deal with on day-to-day? Who reports into them? Who do they manage versus who their managers manage? Because if there are middle managers, there's probably at least some structure to that organization, which reduces the transition for risk for you as the buyer. So that would be the questions I'd be asking, right? When you're looking at the owner transition risk, you're trying to not only understand who reports into them, but as well, what is the transition risk? And the bigger the risk, the lower the valuation on the business, and the more aggressive the purchase price structure could be in your favor as the buyer. Versus in this situation, this is a very well-established business with middle management. The owner is working, borderline part-time in this organization. We knew it when we asked it. So in this situation, the owner risk was very limited, so buyers weren't really worried about that. But the key question is to ask when you're going through this. And sometimes the CIM answers this. Sometimes this is something that you have to just ask the broker on a separate follow-up call after you review the CIM. So questions would be, how many hours a week does the business owner work in the business? A big one. Because oftentimes business owners can't pull themselves away from the business and they put in 80-hour weeks. The question for you is, are you going to put in 80-hour weeks? Or is that business owner doing the work of two people, and therefore you actually have to factor in the hiring of a second person plus yourself to come into that business? Another specific question I love asking is, what does that person do, that owner do, that no one else in the business can do? Usually the answer will be, well, no one else looks at the financials. The owner and their spouse does the financials, but maybe there's something else. Oh, the owner is the one that does all the product design. The innovation side, all the new products and new services, it starts with him. He's the idea guy. Okay, well, if he's the idea guy, are you going to be the idea guy? Is that something that you can continue on? Or do you have to factor that into your forecast to say maybe product innovation is going to decline now because we're losing the owner? And how do we manage that risk? Another one I always love asking the owner is, how many weeks of vacation or days of vacation do you take a year and travel? For business or for pleasure, and just to get an understanding of how many days are they out on the road working for business, for selling, going and meeting customers, versus actually enjoying life. Oftentimes owners don't take any vacation because they're so tied to their business, but maybe they also don't travel to see customers, and therefore there's an opportunity to start rebuilding relationships with customers and uncovering opportunities. The other one we talked about is how many direct reports, which you can visually see through the org chart. Another one is, how involved are you on new customer sales, new customer origination? Do new customers come to you and because they know Frank is the guy, and so we're going to pick up the phone, call Frank, and Frank's going to price the work and then just give it to his team to close? Or do people come through the general phone, through email, through the door? How do new customers come to the business? And the more involved the owner is in getting new customers, the greater the transition risk, because maybe the owner is like the Michael Jordan of the team, right? They founded the business. Usually they know the business inside and out, so they're going to be better than every other employee. So if the employees haven't been doing that because the owner's been doing that, then transitioning that, there's a risk to that, and you need to make sure that either you keep the owner in place and motivated to train people, or you understand if there's a way to delegate that down to staff. The other one is pricing and understanding the technical areas. So usually for contractors, engineering companies, IT organizations, if the owner is involved on the technical side of pricing and work, how easy is it to learn that business? Do you need an engineering degree and 20 years worth of experience? Is there some SOPs, standard operating procedures in place to document how the owner thinks through that? Or is that something that it's all in the owner's head? And so you need to make sure that the owner doesn't leave the business post sale to actually teach the next person how to do that. And oftentimes that's very common in contracting businesses for smaller companies, where the owner, they just know it, they smell it. The opportunity comes in, they know how to price it, they know what to avoid and what to say no to, and you won't know that as the new buyer. So you need to make sure that if that owner isn't involved in that, either A, that gets priced into your price because there's a higher transition risk, but B, you keep that owner motivated and on so that they can teach you post-sale. And then another one is how many customers or suppliers deal personally with the owner. How many people actually pick up the phone and say, no, I don't want to deal with anyone but Frank? Because those are the customers that are probably the greatest risk of leaving post-sale because they want to deal with Frank for some reason. So how are you going to replace Frank if you become the new Frank? So trying to understand, specifically identifying which key customers in that key customer supplier list really want to deal with the owner versus are okay with dealing with anyone within the organization. Okay? But really, you want to go down to the next level. So not only do we want to think about the owner transition risk, but we also want to focus about the key staff transition risk. So in certain CIMs, they'll actually give you a description of what the owner does, and they'll give you a description with the key staff, who the key staff are and what they do. That's what we usually do in our CIMs. But in other CIMs, they don't. They just skip over, they don't really focus in on what that key staff does. So it's really important to follow up. And again, using the organizational chart, trying to identify who would be the key staff here. Well, an office manager is an office manager, marketing, meh. Safety and operations manager, yes. Chief operating officer, definitely. The VP of sales and estimating, pricing and selling, very important. VP of contract sales, very important. Probably the plant superintendent, and then the purchasing manager, probably not, and the desk specialist, not. So really here, you probably have these 5 people that you would, as the buyer, say, they're probably key to this business. So if the CIM doesn't touch on that, a follow-up line of questioning would be to really dig into those roles and say, well, why, talk to me about those people. Help me understand, number one, what do they do? What are their day-to-day roles? How many hours do they work? Are they possibly overworked and will want to start working less once the sale happens because they've seen that their owner, their friend has left the business? Are any of them capable of stepping up into the owner's role? Maybe historically the owner has hesitated in giving more work down to them so that he or she could feel more important because they're the owner and they want to be in the business. But maybe there's an opportunity for you to delegate down to the COO and say, hey, the COO is very capable. What can they do? And then conversely, ask this specific question to say, of the 5 key staff there, what are their greatest weaknesses? What can't they do? What do you feel can't be transitioned to them or absorbed by them if they absolutely had to? And so, zeroing in on those areas, those are the key areas that you as a new owner have to make sure you touch and transition and learn first, because everything else that can be absorbed, you should probably push that down so you can work more on the business rather than in the business. The other one is age. I mean, how many times have I seen situations where in older economy, family-owned businesses, the key staff are also retirement age? What is the risk of them also retiring in the next 3 to 5 years? You should specifically ask that question, especially if they're plus 65 years old. Why would they want to stay on after sale? Do they need to work because they don't have money? They still have a mortgage to pay off and they have, young kids they have to pay for school for? Or, are they just doing it because they like it? But once things change in the organization and the owner leaves, they're like, meh, you know what? Now's a good time to retire. And all of a sudden you've lost your COO. So really digging into the age of the key staff is very important as well. And then another one is, how long does it take to train up that person in terms of the technical ability? So less for the management, but more for a VP of sales or a VP of engineering. How long would it take for someone to be a backup to that role? Because you're trying to identify in the organization, what are the critical roles that you can't lose? Like if I lose this VP of sales, we're cooked. Like there's no way we're going to continue to deliver the same volume of work. The COO, funny enough, believe it or not, most times they're a manager to a manager, so they probably could actually if they were to die, unfortunately, it's not like the business would stop running. But if there was someone that was managing all of the design work or all of the pricing work and no one else around them knows how to do that, well, there's a huge bottleneck there that you're trying to mitigate. So you as the buyer, as you're trying to plan your transition plan, trying to understand who here is too key that we need to start training up and how difficult would it be for them to train up. And then lastly, if there are those situations where there is that bottleneck, there's either that person that's, a couple years away from retirement or is very, very key to the business and there's no backup, bringing up the topic of a closing or retention bonus for key staff is key. And oftentimes I would say the majority of the time, the seller covers the retention bonus. Sometimes we've seen buyers offer up as part of their offer an earnout that is tied to giving money directly to the employees. But most times the onus is on the seller to say, hey, listen, yes, these guys are going to stick around. Yes, I believe this business is sustainable. So I'm going to put my money where my mouth is and actually offer a retention bonus. So having that dialogue, that's a very in-person discussion. But really, as you're going through and understanding the key staff, really implying or suggesting to the seller, geez, if we lose that guy, this business changes completely. I just can't imagine losing that person. Is there any sort of retention bonus that could be structured in place for that person? And let the seller decide. Plant the seed with the seller and let them think through that, okay? Now, another one is, are they understaffed? Oftentimes, especially coming out of COVID, a lot of businesses leaned up. They cut staff. They, kind of contracted in size and people size. And now the business has come back, is doing very well, but they're actually understaffed. They really need that VP of sales that isn't there anymore because there's only just a couple account managers, or the owner is doing double duty and covering multiple roles. So if they are understaffed, which areas of the organization are they? And factor that into your EBITDA analysis. So if there is a VP of sales required, then and you look at the broker and the financial model that they give you, and they say, well, we're going to project $1 million EBITDA next year. Well, does that $1 million EBITDA projection also include the need to hire that VP of sales? Most likely it doesn't, because the brokers don't do that. So you would probably have to factor that salary into the projection. So really, if a VP of sales costs $150,000, the projected EBITDA next year is $850,000, not $1 million. Okay. And then as well, another one is bonus plans. So oftentimes for these smaller businesses, there are no bonus plans, or there's ill-defined bonus plans. So this is an area of opportunity for you as the buyer to understand, well, how are staff incentivized to grow this business, if at all? Are they just salaried? Or are the salespeople in the organization 80% base, 20% variable? Or are they 50-50? Or they're 20% base and 80% variable? The more you can structure that variable incentive to grow, the more motivated they'll be. And I find that there's a lot of opportunities in these small businesses to come in and rethink the compensation plan. And most buyers do. That's probably one of the early levers they pull to really get people rowing the boat in the same direction to grow the business. Another big one, I can't stress this enough, is when you're looking at the key staff in particular, and even just the general laborers and workers in an organization, where do their staff salaries compare to market levels? Oftentimes, in a M&A transaction, once the sale is announced, people look. It's not like they leave, but they look. And especially if people have been, vying and trying to get the owner to say, hey, boss, we're $3 an hour below market. You haven't given us any raise in the last couple of years. Please, like I need something. And the owner's like, yeah, wait till the end of the year. But in their mind, they don't know behind the scenes that he's selling the business. And then you buy the business and you find out, hold on a second, everyone's been waiting for a raise and they're $3 below market. What are you going to do? Those guys are going to hold you hostage. They're going to come up to you and say, hey, listen, if you want us to stay, like we need a raise now. Like get it. So it's like that. You don't want to find yourself in a situation where you're being held hostage after the fact. You want to ask a question up front to say, what are market salaries for these roles? And if they are below market, factor that into your projection, into your historical analysis of EBITDA to say, no, really like this, the labor cost should be a lot higher than it is. So we're going to add that $2 or $3 extra, which is going to add another 100 or 200,000 to payroll. So factor that into your analysis and pay what is truly market, not what maybe the owners have been kind of deferring for a couple of years. Okay. And then the last one is in certain situations, there may be employers that are unionized. And so union is not a bad thing. It's not ideal, but it's not a bad thing. Really, the key question is, what the collective bargaining agreement between the company and the union, which is really the formal contract that they sign, how many years are left on the agreement? When did the union come into place? What are the labor relationships like? And where do market salaries today compared to the union salaries agreed to in the agreement? And those are all very relevant questions because, say, for example, the union agreement is going to come due next year. Well, you're going to buy this business and immediately enter into union negotiations. So most likely you should probably wait, let the old seller do the negotiation and then step in once it's negotiated versus you stepping into the situation. Another is, say, for example, you lock into these collective bargaining agreements, but the next renewal is going to see a huge jump in salaries because people are below market. Well, you're going to get an immediate hit to EBITDA because that union is going to take every single penny off the table to ensure that the salaries jump to market. So these are some of the situations you need to think about when you're looking at those union type situations. Okay, so now moving on to the legal and IT slide. What your first question is going to be like, well, why do I care about this? I'm looking at the finances and the customers and all that, but there are some relevant questions to ask on this slide too. Less so, but at least there are some relevant ones. The first is the accounting systems. What accounting system is the business on? And so in our CIMs, we actually have a section where we just summarize and bullet point list out what accounting system they're on, what ERP system, if any, they're on, and just talk about the IT systems within the organization so you can understand, what are you really stepping into? Is this a very paper-based organization that requires more modernization and therefore probably has a higher transition risk because it's in people's heads and it's on paper that maybe is not available or can't be found post sale? Or are there systems in place that sales, pricing, AR collection, and all that's all tracked accurately? So the less the IT or the weaker the IT systems in the organization, then probably the higher the transition risk for you, and you just need to be aware of that. It's not a material increase in transition risk, but it does complicate things because it's just an older business. So are they on QuickBooks? Are they on Sage? What are they on? Do they have an ERP system? What does that ERP system do? Does it track inventory? Does it also price customers? Is there a CRM where it actually tracks the customers and the information and their historical information? And not only that, but when you're looking to do due diligence on a business, if they have an ERP system and they have an accounting system, then it's probably easier for you to actually get the information you need to do your diligence versus older businesses that have no systems in place. Just be aware that it's going to be a pain in the ass to actually get that deal closed because the banks are going to ask you for information they need. The investors are going to ask you. And you're going to have to find that information, and it's going to take longer, and it's going to require more work to get the same amount of information. Okay, so those are things to consider on the IT side. On the legal side, the big question is the business currently facing any lawsuits? Okay, and so sometimes the CIM will disclose that. Sometimes there are certain situations where the broker just you don't ask a question, so you don't put it in the CIM, and so you need to ask that question specifically to say, are there any ongoing legal disputes that have either happened today or occurring today or have happened in the last 5 years? And that should be a comprehensive enough question to really catch if anything's happened in the last couple of years. And so if there is, you just want to quickly confirm, what was the dispute about? Who was it with? Was it with an employee, which is in a way kind of easier than if it was with a customer? Because if you're in a dispute with a customer, damn, those are the people that are paying you, right? Like what happened? Like why, and did other customers know that you were just in a legal dispute with the customer? Like there's more reputational damage actually if you're dealing with a supplier or customer in a lawsuit than with an in-house employee that, just employee stuff always happens. So, trying to understand who that customer was, how important they were to the business, why did it happen would be key. And then, the question is, if it's an active lawsuit, how does that lawsuit really interfere with the day-to-day operations? Are there a lot of discovery sessions, whereabouts in the process but also like, is that customer still ordering from you, or is that employee a key employee in the business? How does it impede the business, if anything? And then you also want to put a dollar figure to it. Even if it's in the early stages, you want to ask the seller, what do you think, X to Y, give me a range of what you think the potential cost of settling this lawsuit is, the cost of going through the proceedings. Give me those cost estimates so you can kind of factor that in. Because, you can close a business with a lawsuit. The question is, there's probably going to be a holdback in place where you're going to have to leave some portion of the purchase price to offset future legal costs that are going to come to you as the business. And then also the seller is going to have to represent and warrant that they're not going to cut and run, that they're going to deal with this lawsuit and carve it out away from your business. So really, you can buy a business with a lawsuit depending on how material the lawsuit is. But we worked with one situation where it was $1 million lawsuit for like a $6 million business, so very material lawsuit. And more than half the purchase price was left behind to really offset the multi-year risk of settling that payment, settling the dispute, and managing the risk. And the reason why the seller accepted that is because they had to sell. But, if they didn't have to sell, we would have strongly recommended they settle before going to market, because there is going to be a discount associated with any sort of material lawsuit in place. But going back to you as the buyer, when you're looking at a lawsuit, the other key question to ask is, whereabouts in the process are they at? Are they really close to the finish line? So, you're maybe 6 to 12 months away from settling this thing and being done, or did you just receive it and now you're in discovery and it's going to be 2, 3, 4 years? The earlier in the process, the greater the uncertainty around the dispute dollar amount is going to be, the greater the uncertainty around the cost of the lawsuit is going to be. So usually the earlier in the process, the bigger the holdback is to make sure that you mitigate your risk as the buyer. Okay. And the last one is, will the business's staff be distracted or involved in legal proceedings? So say, for example, the lawsuit involves an employee that did something inside the business that, abused the staff or created tension, whatever the case is. Well, how mitigated or how carved out is that lawsuit relative to the other day-to-day operations and the morale of the organization, the quality of the customers, the interaction between people? Because if it's a really bad lawsuit, then probably that business is unsellable. And I would recommend that you wouldn't get into that situation, because the more it spreads and the more it poisons everyone else's day-to-day roles, then why would those people leave? They just go and find another job if they're good enough. So you just don't want to get into those difficult situations. But sometimes the lawsuit's just part of business. There's a little dispute. You terminated an employee and you didn't pay them full severance and they came back at you and you just have to settle it. And, there's just there's a legal discussion to that around carving out the risk, but it's not be all and all for that deal. Okay. So another slide that you're going to see is the ownership slide. So how the business is owned. And so in general, most sellers want to sell the shares of the business because it's more tax advantageous than selling the assets. The reason being, when you sell the shares, you can then, especially in Canada, get a tax-free capital gains exemption of up to $1.25 million per person. So if my spouse and I own the shares of our business in Canada, we each have $1.25 million in lifetime capital gains, where if we sell those shares, the capital gains up to 1.25 is tax-free for me. And also there's another 1.25 million tax-free capital gains for my spouse or my partner or whoever. So in general, especially in Canada, I would say probably more than 60, 70% of the businesses that we sell are going to be on a share sale basis. Very rarely is it asset, whereas in the US, it's much more common to do asset because people want to carve out the legal risk, the tax risk, and all that. But when going back to this, now, if you are going to buy the assets or you are looking at, considering an asset versus a share deal, one of the key questions for you as the buyer is to understand, is the structure of the business set up correctly from a legal point of view? And I've looked at a couple CIMs, just recently, where I'm looking at the legal chart and I'm thinking, this is dumb. Like, these guys didn't do it right. And so the challenge there is that if they haven't set up their business correctly, and there will be tax consequences to get the change done pre-sale, well, that actually, from the seller's point of view, that's seen as a cost to getting the deal done, which limits the amount of proceeds they get out of the sale. So it actually makes things more difficult to get towards a deal, because they say, for example, they had an expectation of a $5 million sale price. I'll sell if I get 5, but then they own the real estate in the operating company, and you just want to buy the operating company, and that real estate's a $20 million piece of real estate, and they have to move that real estate out of the operating company into a real estate company and trigger tax on that transfer. Well, what is the tax on that transfer? And net the purchase price of the business. Now you're already starting off on a back foot, because they're probably not going to get what they wanted in the first place. And so, has the broker told them, or the broker has avoided that discussion and you're the first person to tell them? So all these things kind of play out, but it's important because it actually really interferes with the ability for you to get a deal done. Is it even doable to get a deal done? So let's look at 4 common structures. The first, the simplest, the easiest one you're going to see is me, the owner of the business. Let's just assume there's one owner. I own a holding company, and then the holding company owns the shares of the operating company. In this example, nothing dramatic, pretty simple. If I wanted to sell the shares, you'd essentially buy both entities. But the key question is, hopefully this holding company is empty. Hopefully this holding company doesn't own other investments. If it does, and there are other non-business investments in the holding company, then it may interfere with your ability to buy both, to allow you to essentially buy the shares and allow the owner to realize the lifetime capital gains exemption. So if this is empty, then you can buy both, amalgamate the two, and just buy one set of shares, and the owner gets their lifetime capital gains. If there are condos or stock portfolio or whatever, the question is, will the seller move those assets out of this holding company and trigger the tax associated with that to allow you to buy the holding company? Or if not, you're obviously not going to buy the condo and everything else. So that will not allow the seller to realize the shares, and therefore will complicate things from a tax point of view. So right away, you should probably go to the seller and say, hey, do you know, is this holding company empty? No, it's not empty. Have you talked to a tax accountant? Do you understand that you're probably not going to be able to sell the shares of your business? Oh, I didn't know that. Okay, well, you should probably have that conversation earlier, okay? So the second one is, I've seen this, sucks, unfortunately, but it happens, where instead of the holding company, they kind of quasi move the cash off the operating company up into the holding company and bought the real estate in the holding company. But now the real estate holding company owns the shares of the operating company. So if you ever wanted to sell the shares, but I, as the buyer, only wanted to buy the operating company, well, I couldn't buy the holdco because there's a real estate here. So either you move the real estate out of the holdco, trigger the tax on the transfer, and then buy the empty holdco with the operating company, or you just buy the operating company, they can't sell the shares. So this will also change and impact the net tax proceeds to the seller. Now, in this situation, funny enough, if you're a cunning buyer, you can actually position yourself this way to say, hey, listen, I'm sure you're talking to a lot of buyers. Most buyers aren't going to buy your real estate. But what I'll do is I'll offer you a deal. I'll take this problem off your hands. I'll buy the real estate holdco plus the operating company, but I want a discount because I'm saving you some of the tax burden. So that may be an opportunity to look at. Here's another one. So here, say for example, the seller just owns the shares personally in the operating company. They own 100% of the operating company. And the question for you when you look at that org structure is, where do they own the real estate? Okay, yes, they own the real estate. Where is the real estate? Is it in the operating company? I've seen this, and sometimes you can look on the balance sheet to see if, in the balance sheet there's a reference to mortgages or, the property. But you can quickly determine, does the operating company actually own the real estate? Because in that situation, again, what do? Do you buy the operating assets if you don't want to buy the real estate? Because if you buy the two, or you want to buy the entity and give the benefit of the share purchase, then the seller has to move the real estate out of the operating company and trigger the tax. So, in this situation, if there is real estate in the operating company, most likely you have to buy the assets, give them, which benefits you as the buyer, but you may have to pay a premium on the assets to offset the tax impact that the seller is going to have to realize on that. But this is just poor planning from the seller's part. And some certain situations I've seen, the seller goes to market, realizes, oh shoot, like I didn't realize that, my structure is bad, pulls the business off market and takes a couple of years to do the restructuring. So in that situation, you don't want to waste your time. You should just hit the nail on the head and have this conversation, confirm that they understand what they're going to do and that the extra tax they're going to pay. And if they have accepted that, then great. But if they haven't accepted that, then don't waste too much time. They're probably going to pull the business off the market and they're not really sellers. And then the last one, in Canada, there's family trust where you can set up a family trust. So the owner would still have voting control over the business, but they may have a spouse, they may have children that they've put as beneficiaries in their trust that will own the common shares of the holding company or the operating company. But now, when the business sells, same thing. Make sure that the holdco is empty. You buy the two, and now the proceeds go into the family trust. And now in the family trust, there may be 5 beneficiaries that each have 1.25 million in lifetime capital gains that can now be spread out, and you can virtually get that purchase tax-free if, say, for example, is a $5 million purchase. So this is where the setup is done right. And this right one, I wanted to include this. This is a very common structure. If that seller has gotten proper planning, the holdco is empty, the opco is owned, and then there's a family trust that would essentially receive the ability to spread out the lifetime capital gains. And that owner is going to get that purchase virtually tax-free. But the more dramatic situations that I've seen is when there's poor planning done and there's a real estate holdco, or there's the real estate in the operating company, or the holding company has something in it, or other investments, and it just complicates things. So you just want to get ahead of that, okay? So when you're thinking about the shareholder structure, so I've walked through the legal side and the tax side, but now I want to talk a little bit about the actual psychology of dealing with multiple shareholders. So say, for example, there's 2 shareholders and they each own 50-50. Well, very simply, they both have to agree to selling. But say, for example, there's a structure where there's 3 shareholders and they each own, one shareholder owns 60% and then the other 2 own 20% and 20% to get to 100%. Well, in that situation, who is pushing the sale? Oh, is the 60% partner pushing the sale? Okay, great. What about the other 2? Oh, well, they're silent partners. They're either or. They're on the fence about selling. Okay, well, in that situation, not only do you have to deal with the main majority shareholder of 60%, but you have to understand, can the 2 40% partners, if they choose not to sell, veto the sale and stop the sale? What shareholder agreement exists? What is the decision-making process behind that? And that's a discussion that you have to have with the broker to really get ahead of that so that you're not surprised. You don't want to be in a situation where you've spent all this time analyzing a company and the minority shareholders have veto rights and they weren't really interested in selling, and unless they get the absolute perfect deal, all cash down, they're not even thinking about selling. Well, then that company is not really for sale. That company is just it would nice to have, but it would be really tough to get that deal done. So the psychology behind understanding the shareholder structure and understanding the incentives of each partner that owns that business is key. It's simple when there's 2 equal partners and they're both active in the business and both want to retire, but there may be a situation where there's active and non-active partners. Who is the decision maker? How do they resolve a dispute? Say, for example, the 60% partner wants to sell, but the 40% don't. Have they talked about that? Is there potentially the 60% partner has to buy out the 40% partner first and then sell his 100%? How does that look like? And so, you really need to get ahead of that early on to qualify that opportunity so you don't waste any time. The silent shareholders, if there are silent shareholders, they're the toughest. They're really tough to read. Even for us as the sell-side advisor, when we go in and we pitch a business, we're oftentimes thinking, okay, how do we avoid the risk of these guys changing their minds, stopping this deal? Because we may be dealing with the day-to-day owner, and they may be perfect. We're all happy. We get the offer. We get it signed up. We get to the point where we're actually closing, and the silent partner's like, you know what? I was never okay with this. I'm not comfortable. I'm not selling. And then they can just totally derail the deal. So the broker, funny enough, is just as invested as you as the buyer is in making sure that the deal gets across so they can get their commission. So I would definitely spend a lot of time with the broker in a multi-shareholder, especially when they're silent shareholder situation, to just ask them, tell me the story. What have you done? How have you gotten comfortable with taking on this deal? And the more information you have, the more you can qualify whether the broker has managed it correctly or if they've really just kind of gone straight ahead, ignored this risk. And now you have to, decide whether the possibility is there. Now, as well, there are certain situations where maybe there's a silent partner, like the relationship, the type of relationship. A silent partner could be an investor that's backed an owner or a founder and an entrepreneur to own a business. But a silent partner could be a supplier. It could be a customer. It could be an associated vendor that's, adjacent but not right in the same space. So, really when sometimes in the CIMs, they'll say, oh, Jim is the 60% owner of the business and there's 40% silent partners. And that's all they talk about in the CIM. I would follow up and really dig into the 40% and say, okay, how many are there? Who are they? Disclose the names. I want to understand. And if they resist or they kind of they get around that issue, my ears would perk up. That's a red flag because I want to get comfortable. I want to make sure, do those partners have any sort of right of first refusal, or maybe they have a drag along, tag along option in the shareholder agreement as well, where, say for example, you make an offer and they don't like that offer, but the seller, the 60% active partner says, you know what, I want out, just take me out, and the 60% partner accepts that, and all of a sudden the silent partner is like, okay, well, I'll trigger my ROFR and I'll just buy that first, and I'll buy you out at the value that you received from this bloke that just gave you this offer. So there, you really want to understand the legal structure in place in which those silent partners may potentially cut you out of the deal as the buyer and actually just grab the business themselves if that is an opportunity. And then not only that, but then the silent partner, if they are going to be a key customer or a key supplier, are they and somehow adding value to this business even though they're silent? Are they supplying IP, providing shared services, giving, not being as aggressive on pricing? What type of special deals or situations exist because they're an owner in this business, but now moving forward, they're going to sell. So you as the buyer have to understand that, and then also make sure that you sign an agreement that guarantees the ongoing support and the same support that they were previously receiving, so that you don't step into a situation where, say, for example, a silent partner was a supplier, and the supplier is like, I haven't raised prices in 5 years. You close on the deal, and after the deal, they start getting aggressive with you and starting to more proactively increase pricing. Well, all of a sudden, you're in a tough bind because they don't care. They're not an owner of that business anymore. So again, those are things that you really want to kind of get ahead of and understand. So another slide to look at is the real estate property slide. And so there's kind of the fork in the road is, does the seller own the real estate or is it leased? So if the seller owns the real estate, the first question is, do they want to sell it? Do they want to hold it for income and they want to be the landlord to your tenant, or do they want to sell it right away? And if I am not interested as a buyer in buying it, will they immediately sell the property afterwards, after the process is done? And these are the questions that you just want to firm up. Where is this going to go? Like, who is going to be my landlord post-deal? And then the next question is, what is the market value of that property? So have they gone to an appraisal? Have they talked to a broker? What is the relative value of that property? And you can do your own confirmatory due diligence on the side. You can go to a local CBRE Colliers broker, or whoever is playing in that sector, to say, okay, well, what is this thing worth? And then you want to make sure that the value of that property is properly reflected in the rental rate that the business is paying. And oftentimes, especially if the owner owns the property, they are usually not charging themselves market rate for that property. They're usually below, or they're not charging at all, because why would they? They own the property as well. They don't really need to charge themselves rent. But when you are buying the business moving forward, you want to make sure that you're pricing in the correct rent into the EBITDA, so that it's essentially, you're assuming that it's a third-party landlord, that EBITDA is sustainable moving forward. Okay. And so this is this example right over here. So if the historical rent in the business was $75,000 on the financial statements, the appraised value of the building was $1.75 million, and you cross-check that with your own broker on the side, and the market cap rates in the region for the type of property that it is 7%, then you can very quickly you take 7%, multiply by 1.75 million to get the 122,000 net operating base rent. And so that would be the base rental rate plus TMI, so plus the taxes, maintenance, utilities, everything else that was also included in the P&L. But just purely base rent, if it was 75 and it's really market is 122, the $47,000 $100,000 adjustment downwards in EBITDA is required to be reflected. Now, the challenge is some owners are going to be like, oh, well, I'm going to give you a sweetheart deal. You know what? I own the property. I have no interest in selling it. I want to make sure that I have like a protect the EBITDA value so I can get the highest maximum price for the EBITDA. And then I'll just, accept I'll just lease this out for the next 5 years at $75,000. My comment to you as the buyer is you shouldn't accept that. Number one, it's not smart from the seller's point of view to give you a discounted rate because God forbid they have to sell that property. They're now in a below market lease rate. And regardless of what the property is worth, the investor is going to price it off of cash flow, and they've limited themselves in their value of their real estate. But then B, you've now set yourself up for eventually 5 years down the line, there will be a hit to EBITDA. And so you've still inflated the value of your cash flow for a couple years, but over the long term, if you're thinking about owning this business for 10 years, 15 years, you're still going to wake up with an EBITDA adjustment later on down the road. So why not just price it in up front, manage your risk up front, and pay for what the business is truly worth? Because you're going to pay a multiple of that. So you're going to pay an extra, say for example, you buy the business for 5 times, you're going to pay an extra, $250,000 in value that isn't real value because it's just a sweetheart deal for 5 years that's going to go away after the fact. So that's really important to consider. Now, if the property is leased, then the situation is different. Now the question is, well, how many years are left on the lease? How many years do I expect I'm going to be in this place? Are there any extensions? So if I have 3 years left on my lease, how many additional extensions are built into the lease to make sure that I'm here? And then the big one, especially for businesses that are based in the city or close to the city, is there any redevelopment risk? If the owner of the property is a big commercial landlord and they're holding that property to eventually redevelop, and I have 3 years left on my lease and one more extension of 5 years, how realistic is it for me to assume that after the 3 plus 5 or the 8 years in that property that I'm going to still have the opportunity to lease after the fact? Because then that feeds into the third point, which is how important is the location of that property for that business? If it's a retail business or the closeness to a certain industry or the closeness to the highway or whatever the case is, if the location really influences the competitiveness and the cost structure of that business, and you know that property is eventually is at risk of being redeveloped, and you don't own that property and you can't own that property in the future, then just realize that the risk of moving that business is real, and that may influence the overall value of that business in the future. That may compromise the future value, may limit the value for you when you want to exit of that business. So you may have to price that into your price. Maybe you don't pay maximum value because of the redevelopment or move risk that exists with that. But in general, if you are buying a manufacturing business or something where the property is really the core value of that business, core competitive edge, it is absolutely critical that you own that property as well, because you put yourself at a disadvantage if you just lease it. Now, say, for example, you don't have the money to buy that property. Well, a good way to do that is actually to buy the business, but then in the business purchase agreement, also have the option that within the next 2 years, you will have the ability to buy that property at an X amount of value, or have a right of first refusal built in to ensure that you have a chance of a first crack at buying that property, so that you don't lose the ability to own that property in your future. But at least you can buy the business, start paying down the debt for the 1 or 2 years, and then go back and buy the property after the fact. But that's really critical. And then the last thing that I'll talk about, or the two last things I'll talk about on the property side, anytime there's a property related situation, I always talk about capacity. So how much capacity is left in the property to grow? So if you're in a manufacturing entity, are you at 80% capacity, at 100% capacity, or 30% capacity? How much space are you using today versus excess space? If it's really, really, really tight and the business has been growing consistently over the last 5 years and you're paying a growth-related multiple, that's great. The business is growing and there's more demand, but you need physical space to support that business. And if it's at capacity, then there's a real step up in cost because now you have to find more space. Either you build more space on there or find a second location, and that needs to be factored into your analysis on the EBITDA side. So if capacity is really tight and the business is growing, then yeah, you could pay a growth multiple, but also factor in the additional costs of adding more space into the business. The other one is CapEx. So if even if you don't own the business, or even if you don't own the building and you lease the space, how well maintained is that property? Is the roof Has the roof been replaced in the last 10 to 15 years? Is the parking lot been paved? What is the quality of that building? Pride of ownership. If that owner has really milked every single last dollar of that business and hasn't invested in the building, then probably the quality of that building is very low. And there will be a lot of tough discussions in the future where you are growing, you want to improve the quality of your business, but your landlord is cheap and doesn't want to spend money on the building. So that should also be factored into your analysis to say, hey, maybe we need to share some of those costs, and therefore I need to factor that into my EBITDA, that I'm going to pay for some improvements to the building myself and amortize them over time. Or I need to negotiate up front with the owner that I'll pay you X for the business, but I expect that in the next 2 to 3 years, you're going to do X, Y, and Z in the building to make sure that the quality of the building is maintained. And then the last one is environmental. And this is more relevant for manufacturing, distribution, industrial type businesses. But depending on the type of business, if you're dealing with any types of chemicals, fluids, waste, anything that could potentially contaminate the ground, then it's really important for you to confirm that the environmental quality of the property, even if you don't buy it and you just lease it, is good, so that you have a baseline. So we always strongly recommend that, a seller gets a phase 1 environmental report, which confirms the quality, the environmental quality of the ground. And that sets the benchmark for between when they sold the business and they continue to stay on as a landlord, that any changes in the quality from then, there's a benchmark, and the difference in the changes is the responsibility of the new business owner. But that way it removes the potential risk of, say, for example, you buy the business, there's no environmental benchmark report, then a couple years later, the seller sells the building and goes to you and says, hey, it's contaminated, it's your fault. And it's like, hold on a second, I've owned this thing for 3 years, you've owned it for 40. Probably you contaminated it and I've just continued to run it. So you want to make sure that there's a benchmark in place if there are environmental related risks. Okay? So we're getting close. So now let's talk about, at a high level, when you kind of summarize, our review, what are the best practices when you're looking at the CIM? And as I mentioned before, there are certain things that can be put into the CIM, but remember that the client is going to sign off on the content. So you can't put the juiciest details or a little bit negative details that the client may say, hey, just take that out. They'll ask about it, but we were not going to put it in writing. There are those types of conversations that happen between a broker and their client. So it's really important for you to get on the phone, and I really encourage this. Don't just get the CIM, read the CIM, and then make your assumption. Read the CIM and then get on the phone and ask the broker first. Tell me about the business. How did you get it? What do you think about the business? What are the conversations you've had? Tell me about the shareholders. Is there anything that you excluded from the CIM or you felt that you were limited from putting into the CIM? Tell me about that. And then as well, trying to be that investigative journalist to really dig in. It's about being patient and asking the questions once, twice, 3 times over in different meetings. Maybe you ask the same question of the broker, but then when you meet the seller, you also ask that same question to confirm if the answers are the same. Part of this whole process is that you're not going to have all the information up front. You're going to be a bit in the dark on the front end. So, don't wait to get 90% comfortable on a deal to put in your preliminary expression of interest. Maybe you get 50, 60% of the information, you put in a preliminary offer that's non-binding, you then sit down with the seller, they give you more information, now you get more comfortable and you get to 80, 90%, and then you put in a letter of intent, they sign it back, that you go exclusive, and you confirm the last 10, 20% of the information in diligence. But very rarely, I haven't seen a deal where a buyer has been able to essentially say, I'm 90% comfortable pre-offer. That just doesn't happen. Usually they will have the high level building blocks. They feel like something's there. They feel that they're relatively comfortable, subject to confirmatory diligence. They put in an offer. They take the next step. They put in the second offer. They take the next step, and they get exclusive and then confirm everything else in diligence. That's the way the business works. So a lot of first-time business buyers, they're overly concerned about having everything up front. The reality is that's not practical. You're not going to be able to get everything up front. And just realize, and I put this right here, there is no perfect business. I can't stress this enough. Every business has risk. And in order to be a successful buyer, it's not about avoiding risk, but about structuring the deal in a way in which you can mitigate that risk. Because at the end of the day, you make your money on the buy, not the sell. Whatever you pay for the business, if you overpay for the business up front, you've set yourself up for failure right away. And yes, you can dig yourself out of a hole, but the returns are going to be compromised from day one because you overpaid for that business. So it's really important to structure and price the deal relative to the risk that you uncover as you proceed. And another thing is reviewing CIMs, and I've given you a bunch of common questions to consider. While it's great to have these common questions, there's a lot of experience involved. I've probably I look at 100 150 CIMs a year. So, and I've been doing this now for almost 10 years. So there's a lot of information that you need to kind of look at and sift through, but there's trends that you start to spot. So don't feel like, if you look at a sim and you're not really picking up on those things right away, that's just a skill gap. That's experience. You just need to keep doing it. Keep looking at sims. Keep, doing that and having different conversations with the brokers. And some brokers will be better than others. At the end of the day, a bad broker is going to impact the deal. The reality is bad brokers make bad clients. So if a broker has prepared the information in an incorrect way or set up the client incorrectly, realize that you probably are wasting time trying to chase that deal, because that deal is either not going to close at the price you want, and it's really hard to change the client's mind once they're entrenched. Okay. And then the last one is develop a list of quick no's. So for you, say for example, you absolutely want to stay away from customer concentration. Well, if you pick up a sim and you see customer concentration, drop it. Don't even look at the financials. Just move on. Like, the reality is there's so many businesses out there. And for you as the buyer to be efficient with your time, you need to sit down and say, what are my absolute no's? What are my quick line in the sand no's that I will never look at? Like, I'm not comfortable in wrapping my head around those types of risks. And if I see them, you just walk away from the deal. Because oftentimes inexperienced buyers, they want to see everything. They want to really dig in and read the full story, take the time, but that takes you away from finding the business that you actually want to buy. So you need to be efficient in saying, there's a lot of fish in the sea. Don't worry about just saying no to a deal. If it hits a quick no, just move on and just keep focusing. Okay. So last slide. And I put this image because it made me laugh here, but we're going to summarize essentially all 3 videos into this bullet point list of what a buyer really wants. And I took this list actually from a couple conversations with private equity firms and financial investors and professional business buyers. And I essentially asked them, I was like, what do you really want? Like, if you were to say, this is the perfect business for me, or these are the things that I'm looking for to really want a business, well, what are those things? And the reality is, if you've watched all 3 videos, every single bullet point touches on every single topic that we've talked about today. The first is B2B. Most people don't want to deal with B2C because of the pricing power issue. When you're dealing with B2C, there's usually more substitutes available. And so the competitive positioning of that business, because you're not in a niche sector or an essential sector where people are trapped and stuck with dealing with you as a supplier, there's more price competition, there's less pricing power for you as a business, and therefore your margins are lower. So most people want to see those B2B essential niche industry type businesses. The second one is a fragmented competitive landscape. You want minimal competitor power, and you want the opportunity to consolidate and buy. So again, going back to the Porter's 5 Forces model in part 2, we talked about how many competitors are out there, how big are they, how much power do they have, what's the next best alternative. If there's a ton of tiny competitors out there that no one can really kind of push their weight around and get a lot of volume, then really that's an opportunity for you to become that, to buy a couple and get to that point where you are that big competitor in the space. The other is a diverse customer supplier base. So most professional buyers want to stay away from customer concentration. They just can't wrap their head around it. Anything above 40% or anything above 50%, it's a quick no for them. But maybe 20, 25% is more easy if there are certain contracts in place. So it's important to understand what is that certain level that you're looking at in terms of concentration. The other is the recurring loyal customer base. So going back to that printer and ink conversation we had in part 2, business buyers really want to look at businesses where you don't have to continually work to find the next customer to sell them on that one big item. They want to sell consistently to the same customer base because it's a consumable product, or it's something that's recurring in nature, or it's a software as a service business where there's a subscription in place and every single month that customer is writing you a check. There's less work involved in really maintaining those customers because they're so recurring versus trying to find a big one-off single ticket purchase item and finding those customers. So the work involved in maintaining and the stickiness of those customers, it's better if they're recurring and they're a loyal customer base. Another one more on the financial side in part 1 is the type of profitability that they're looking for. business buyers want to see at least 15% EBITDA margins plus. The reason being, anything below 10% is low margin. There's not a lot of buffer for potential one-time costs that will then eventually put you into the negative profit territory. Versus when you have 15, 20, 25%, there's real pricing power, and the financials confirm it. If you can really get 25% net on a business, and you have a fully scaled business that is generating at least $2.5 million a year in EBITDA, well, then at that point in time, you have scale, you have the overhead costs, but you still have the ability to price your products at a higher level than other sectors where price competition is a lot higher. So margins are key, especially when you have a high margin in a big EBITDA business. Another one is growth. Sales need to be consistently growing at 5 to 10% over the last 3 to 5 years to show that the industry is expanding, that there's momentum behind the business, that they must be doing something right. Maybe there's a competitive edge. And so the historical financials will confirm the direction of the business. If a business is flat, it doesn't mean that it's bad. It's just that, if you really want to find the perfect business, well, a perfect business is probably a business that has a competitive edge and that its market is growing and that they're able to recruit and find more customers. So therefore, there's a steady growth rate behind their sales level. And then lastly, low CapEx industries. So even though CapEx and asset-heavy businesses protect you from a new market entry point of view, because a barrier entry could be spending money to get into the space. The challenge is once you spend money to get into the space, you have to keep spending money to replace those assets, to maintain those assets. And the challenge with that is that then even though you may be generating $2 million in EBITDA, if you have to keep replacing $1 million worth of assets every year, your true cash flow as a buyer, your free cash flow, is only $1 million. So you're limiting your actual real return, cash on cash returns, because of the high CapEx. So most buyers want high cash on cash returns, obviously, and therefore they want high EBITDA and low CapEx, because that allows them to put more money back into the business and to return more money to their investors. So all of these things essentially capture all three parts of the three-part videos, because it really summarizes kind of the things that you want to focus on: the quality of the customers, the quality of the industry, the quality of the financials, the quality of the pricing power, the type of assets owned, the CapEx cycle and the equipment list. All of these things are touched on in this slide. And that's the power of when you think about analyzing a CIM in summary. The reality is all of these variables play into your analysis. It's not just the financials, or it's not just the business and industry itself. It's everything. Maybe they're in a really good sector, but the financial performance is weak, and therefore there are structural issues behind that. Why is the financial performance weak if the industry is so strong? Are they not pricing correctly? Is the management team not capable? And vice versa. There are really good management teams or really aggressive owners that are special and are able to generate really good returns. So the financial side of the business may be really strong, but the core long-term fundamentals of that industry are risky. Well, in that situation, you're stepping into a situation where either you have to be just as special as that owner to continue to deliver on those margins, to continue to deliver on that growth, but really the long-term trends and fundamentals of that industry are going to put pressure on you, and most likely that business will contract in size. So it's a balancing act of finding the two and analyzing everything on a global scale. Okay? So that's it, guys. Thank you so much. If you watched all three videos, firstly, hats off to you. I hope I was able to kind of give you a lot of information here. Really, the whole goal of this channel is to try to empower business buyers to buy businesses, to help them feel comfortable in buying businesses, because we need more business buyers in our sector. So please, if you have any questions, please comment below. If you feel like you found this helpful and you really want that one-on-one session with me, you can book through our link on our website. You can go in the video description. And if you have anyone that you think may be interested in buying and or selling a business in that $2 to $50 million EBITDA, enterprise value range in Canada, please reach out to me. I'm more than happy to have a conversation. So I appreciate your time, guys. Thank you for your support for the channel. Have a wonderful day. Thank you.